Welcome to The Explainer. All right, today we're putting on our investor hats and taking a deep dive into one of the most recognizable companies on the entire planet, the Coca-Cola Company.
Let's kick things off with a number that should make any income investor sit up and pay attention. 64. That is the number of years in a row that Coca-Cola has increased its dividend. That's not just reliable, that's what earns it the title of a true Dividend King.
So, here's our game plan. We're going to explore why Coke is so much more than just a soda company. We'll look at its powerful competitive moat, its huge strategic pivot, the financial results that came out of that, and then we'll get into the risks and the final verdict from an investment perspective.
Okay, let's get right into it. What makes Coca-Cola so dominant year after year? Well, it all comes down to what investors call an economic moat, which is really just a fancy way of talking about the competitive advantages that protect it.
And it all starts with the brand. I mean, the Coca-Cola name by itself was valued at a staggering $35 billion in 2024. That's not just a logo on a can. It's a real, tangible asset that creates incredible loyalty and gives the company serious pricing power.
Now, that brand power is what gets them in the door everywhere. Coke's products are sold in 33 million different spots. We're talking restaurants, tiny convenience stores, giant supermarkets in over 200 countries. The scale is just mind-boggling and basically impossible to compete with. And you see it constantly reinforced, right? With around 14 million of their branded coolers and vending machines scattered all over the world. But here's the thing. They're not just there to keep drinks cold. They are basically mini billboards, perfectly placed to get you to make that high-margin impulse buy. So here's the crucial point. When you combine that world-famous brand with a distribution network that's just everywhere, you create this massive wall. If you're a competitor trying to build something like that from scratch on a global scale, it's practically impossible. And this is where it gets really clever. It all works together in this amazing virtuous cycle. The famous brands make people want the drinks. That demand forces every store to carry them. Seeing them everywhere reinforces the brand. And now the really smart part is they're using data from those 33 million touchpoints to refine their strategy, which just makes the whole system even stronger. It feeds itself. But, even a kingdom has its challenges. And for Coca-Cola, the big one was the entire world starting to turn away from sugary drinks. They had to adapt or they were going to risk becoming a dinosaur. And this is where CEO James Quincey comes in. He took over in 2017 and immediately launched this massive strategic overhaul. I mean, they made some really bold moves. They sold off their bottling operations, they jumped into the coffee market by buying Costa Coffee, and they got ruthless, cutting 200 zombie brands that just weren't pulling their weight. The mission was crystal clear, but it was huge. Pivot from being just a soda company to becoming a total beverage company. We're talking coffee, sports drinks, fancy water, you name it. Basically, they wanted to have a drink for you no matter what you were doing or what time of day it was. So the million-dollar question for any investor is, did it work? Was this massive pivot worth it? Well, the numbers tell a pretty fascinating story. Now, at first glance, you might see revenue go down from 2015 to 2018 and think, uh-oh, that's not good. But here's the thing. That was totally intentional. That was the result of them selling off their bottling businesses. Now, look at what happened to the operating margin. That's the real story here. And that is the payoff. By becoming this leaner, capital-light business that focuses on high-margin stuff like concentrates and syrups, the company got way more profitable. The operating margin jumped from the low 20s all the way up into the high 20s, even low 30s. And for an investor, what does that mean? It means more powerful, predictable cash flow to fund that dividend we talked about earlier. Okay, so it's not all perfect. No investment is. And the big question with Coca-Cola has always been about its price tag. This stock pretty much always trades at a premium. So as an investor, you've got to keep an eye on these things. The health trend away from sugar isn't a fad, it's real. These sugar taxes are popping up in countries all over the world, and that's a direct threat. And yeah, that premium valuation just means there's less room for error. You can see that premium price tag crystal clear right here. This is a key valuation metric, and it basically shows that Coca-Cola trades for a lot more than its main rivals, PepsiCo and Keurig Dr Pepper. You're simply paying more for each dollar of its earnings. However, the argument is that you get what you pay for. The source report we're looking at says this premium is actually earned. It's justified because you're buying a higher quality, more stable, sleep well at night kind of company that performs well in just about any economy. So, the final verdict from this analysis is a buy. But, and this is a big but, it's a specific kind of buy. This isn't a stock that's going to double overnight. You should think of it as a core defensive cornerstone for a diversified portfolio, perfect for someone looking for stability, income, and some modest growth over the long haul. So, the key takeaway here is that Coca-Cola isn't the same company it was 10 years ago. It has successfully navigated a massive strategic shift and has come out arguably stronger and more profitable. Which really just leaves one final question for you to think about. Is this defensive Dividend King the right anchor for your portfolio?